And Jordan, I'll kind of wait for your cue to think that we've got a good group to get started, but ready whenever you think we've got the right group.
Yeah, I can go ahead and do my intro just so we have plenty of time to answer any questions that may come up. So thank you for joining us for today's Small Business Taxes 101 webinar with Mandy from NHCPA. Before I hand over to Mandy and get started with today's webinar, just a few quick things. You are welcome to ask questions. Just drop those in the chat box for us and we will get them covered either throughout the session or before we wrap up today's webinar. And then you'll get a follow-up email tomorrow morning with a recording of today's session so that if you missed anything or you want to share it with one of your coworkers or something like that, you will have access to do that as well. And for those of you who have been on our webinars before, I do want to apologize that I'm not on screen this afternoon, having some tech issues. It's just been one of those days. So I will go ahead and pull up Mandy's presentation here so we can get started. And Mandy, if you want to go ahead and introduce yourself while I get this ready, we can get started.
Okay, perfect. Thank you for that. Thanks for joining us today. I appreciate everyone taking time out of their day to talk taxes. Always exciting for me, sometimes exciting for other people. But my name's Mandy DeJarnette. I'm a tax partner at MHCPA in Champaign, and I've been working here for a long time. I've almost been at the firm for 20 years. I've been in Champaign that long and went to U of I grad, tried Chicago for a little bit, but enjoyed downstate a little bit more. So that's where I've ended up. And I do all things taxes. I really enjoy business taxes, especially flow throughs. I do a lot of partnerships and S Corp work. So I'll dive into a little bit of that. But I also work with individuals, C Corps all across the board. And our firm does all that range of things and more, including, I know if you've been on these prior webinars, you've talked about some of the accounting work we do, our business advisory services department. We've kind of got a lot of different ways to help people. But today you've got me since we're talking taxes. And Jordan, is it good if I just sort of kick off? I see you're sharing this PowerPoint, so thank you for that.
Yep, go right ahead.
Great. So when I heard about the topic, I had a lot of different ways that I could dive in. I'm hoping to make this, the 101 of it is kind of hard. I'm trying to make it broad and relevant, but also deep dive into parts of it, hoping that people have takeaways from it. So the next slide I've got is showing a little bit of the topics that I'm hoping to address. The basic business tax principles. So most people are well aware by the time they're working professionals of how their 1040 works. People know how their individuals work, but business tax owners have a whole different array of things that could come up for these business tax principles. So we'll dive into some of the basics. The place that my brain goes when I want to start with these is usually the fact that when you're talking business, that's a very broad topic, and there's several different types of businesses that have different tax consequences. So I will spend a good amount of time talking about choice of entity considerations. Most of the time, once someone's up and running with a business, that choice of entity has already occurred. But I do want to make people aware of the different types of tax situations that happen from partnerships, corporations. What are the options there? For a couple of reasons. One, if you're consulting with anyone that's doing a new business, I want you to know that there are options so that you're tagging your team of professionals early in that conversation to make sure you're accomplishing your goals. And then two is just because you are one type of entity does not mean that you forever have to be that type of entity. So if you are seeing your goals would be better accomplished as a different entity, it is worth talking to your tax professional, to your attorney about that, because some ways are easier to convert than others as far as changing your entity setup. So we'll spend some time talking about those, and I'll try to get into like the differences of business tax in each of those in a easy to digest situation. And then we'll spend some time clarifying common business income tax items and misconceptions that I'll see from different areas as I'm working with small business owners. And I will try and leave time for Q&A at the end as well. If you do have questions while I'm on a topic, feel free to throw them in the chat, and we'll at least have those saved for us at the end if we don't get to them before that. So we can dive into the next slide. Thank you. So overview of business taxes is extremely broad. The second key here I've listed, there's lots of different types of business taxes, as you'll figure out as an entrepreneur or small business owner. Income tax, self-employment tax, payroll taxes, state and local, sales tax. And then I just put other because I probably could go on a lot longer. Excise, franchise, property, gross receipts. That's not to overwhelm you, but to say that there are a ton of different ways that businesses do pay tax. We're going to focus and narrow in on income tax today. That's where we'll spend our time, but just sort of complicating it to show you there's a whole lot of other ways that businesses participate in the tax system. But on the income tax side, if I was going to oversimplify, I would say there's one of two ways that that businesses, I should say, are going to pay tax. Either the business itself is a tax-paying entity and will pay its tax there, or the business is what is called a flow-through entity, and the business will calculate the income and the taxable income and all of that, and then push the income down to the owners in that flow-through situation, and the owners will pay the tax on their 1040. Those are going to be your partnerships and your S corps, if you're familiar with those. But really, to completely oversimplify, somebody's going to pay tax. Either the business is paying tax or the individual. And unfortunately, in certain situations, both. They call it double taxation in one of them. In general, the business is going to have some way that they're tracking all of their revenue and all of their expenses. And then there's a math put to it, some rules on what's allowable and the timing and things like that. But at the end of the day, it's, again, oversimplified, revenue minus expenses is your taxable income. And that's going to get taxed somewhere, either at the corporate business tax return if it's a tax-paying entity, or it's going to flow through in these K1s to the partner or owner tax returns and get taxed there. So that's kind of the oversimplified version of it. We'll get into a little bit more of the details further on in the webinar. So let's move on to the choice of entity. So I alluded to this at the beginning. It's almost like I can't have a super deep discussion on business income taxes until we've at least touched on these different choices of entity and their tax implications. This could definitely be a whole course, so I will talk pretty high level on all of these. But the business structure, and I've listed some very common ones at the bottom, but this is going to influence a whole bunch of different things, from your everyday operations to definitely how much, when, and how you pay tax. And then there's the whole other side of it, the legal side of it. What is your liability protection that your attorney should be weighing in on? It also affects things like, how easy is it to get cash into the company or out of the company? What does adding new owners look like? What does your exit strategy look like? All kinds of things need to be taken into consideration when you're picking your entity. So these common ones, if you don't pick anything else and you didn't actually sign up to be a specific type of entity, you are a sole proprietorship. If you're starting to run a business and you didn't file something to be an LLC or to be a corporation, the default is you are a sole proprietor. So if you start collecting gross receipts for anything, you're a Schedule C person, you're going to put it on your 1040, and that income is required to be picked up on your 1040 as a default. Schedule C is what you'd be filing there. You're going to sum all of your income, revenue, all of your deductible expenses go there, and that's going to sum down to your taxable income. And then that gets taxed on your 1040, just like everything else. It's going to go in with your wages and your interest and all of the other income items there. So that's kind of what happens if you don't intentionally pick a different type. And sometimes people are sole proprietors on purpose because that's what makes sense to them. It's usually going to be if you don't need liability protection. I'm not an attorney, but I highly recommend whatever you're doing in business, talk to an attorney. The sole proprietorship is going to give you zero liability protection, so that's the huge risk there. If you want liability protection, among other things, you're going to need to go into one of these other entity types. And so that's where you've got partnerships, S corporations, C corporations, and then at the bottom I put LLC, which is a limited liability company. And it can be a single or multi-member, which there's different tax consequences there as well. I'll touch very briefly on each of these. And I've got a slide later that shows a much more complicated grid of the different consequences of these. What's your liability protection? Where are you taxed on this income? All of that. So you can refer to that later. But the partnership and the S corporation are the ones that I referred to earlier that are flow through entities. So these are separate legal structures. Everything's going to be run through these. You have to register with your state, talk to your attorneys to get these entity documents in place. But once all of the income is in there and you've got your expenses against that, you file a tax return showing what the net taxable income is from these. These entities in general don't pay income tax. The income instead flows through to the individual's tax return. So that's why they call them flow through entities. And so In a partnership, the partners will be the ones that pay tax on their 1040 for this. An S corporation, it's a little bit different because it's related to stock instead of partnership ownership, but it's still that taxable income, that net taxable income goes through to the 1040. Separate from that is the C corporation, which is, I think, what a lot of people think of when they think of a corporation. They're usually thinking of a C corporation. This is its own separate entity that pays its own separate tax. So a C corporation does the math for revenue minus allowable expenses. There's going to be a taxable income there, and the C corporation has its own tax rate on that. Before 2017, the C Corp tax rates were pretty stiff. They were pretty high compared to individual rates. So they were not nearly as popular back then. They kind of fell off of people choosing those because the C Corp would pay a pretty decent high tax rate, especially if there was a high amount of taxable income. And then C corporations have something called double taxation. The corporation itself pays an income tax. And then when there's profit to distribute to the owners, there is a dividend tax that the owners have to pay on that. So there's literally 2 layers of taxation there. In the 2018 tax law changes, they lowered the C Corp rate that made even this double tax is much more comparable now to what the flow-through tax is on high income. So while you still pay 21% at the C Corp, 15% on dividends, the math works out that it's actually much closer to what you would pay on a high amount of income on your 1040. So C Corps have been back in the game, so to speak, as another entity choice way more often than it was for a while. But just know when people refer to double taxation, that's what they're referring to, those C Corps that have their own tax bill plus the dividend tax when there's owners involved. So I would say when we're talking small businesses, I don't see a lot of C Corps, mostly because of that double taxation. Instead, I see a lot of people choosing partnerships or S Corps. And there's pros and cons to those when you're kind of comparing those apples and oranges to each other. But I will take a minute and say, with partnerships, one extremely popular option is the LLC, a limited liability company. There's been a lot of law put into place that make these very viable partnerships. They are easier to run than some of the other general partnerships. And also, this is where an attorney would come in to speak, but they can limit the liability of the partners better than general partnerships. So LLCs, limited liability companies, they are extremely popular. You will see a lot of those now. They're easier to set up and they've got great liability protection with them. But the thing I wanted to point out is the single or multi-member. So if you have more than one partner in an LLC partnership, you have a partnership tax return you have to file. It's a 1065. That's the one where it does the math on revenue minus expenses and then gives K1s to the owners, and that's how they report their income, and that's where the tax is paid. The interesting twist that a lot of people will use for some of these is if you have a single member LLC, so there's one partner that 100% owns the partnership, then it simplifies the structure from a tax standpoint. If it's a single member LLC with 100% owned by one person, then it's considered a disregarded entity for tax purposes, meaning there's no separate tax return to file. So interestingly, you kind of come full circle and you're going to report a single member LLC back on your 1040 on a Schedule C, just like you would with a sole proprietorship. So the reporting of it is simplified quite a bit. However, having that single member LLC set up as opposed to a sole proprietorship gives you a whole world of difference in liability protection. So from a tax standpoint, single member LLC and sole proprietorship are taxed 100% the same, but from a legal standpoint, they are completely different. And most companies at the end of the day are going to want to have that liability protection. So the LLCs are pretty popular. In Illinois in particular, it's not very expensive to file to become an LLC. And then the annual fee is $75 a year. So it's pretty cheap to renew that every year for that liability protection that it offers. Okay, that was my extremely fast, high level explanation of that. And I wanted to touch on that just because it shows different flows for different types of ownership. And as promised, here's a little bit more complicated version of this. Should touch on a lot of what I said. So hopefully this would be something good to refer to if it was something you're interested in later. But I can just talk a little bit further on some of this while we're on this slide. The The sole proprietor, if you look in that liability column, it's got the unlimited personal liability. So your personal home is at risk if you're just a sole proprietorship, whereas with some of these other ones, the LLC, the C Corp, the owners are not personally liable, which is really important to think about long term. At the top, the second one, the partnership, that's the general partnership that I was talking about. And that's why you'll see unlimited personal liability unless structured differently. There's limited partnerships or the LLCs, which we talked about. Partnerships by definition have to have 2 or more owners to be a partnership. The LLC, because of that single member LLC exception, can have 1 or more owners. So that's a little bit of a difference there. One thing I did not talk on earlier is self-employment tax. So this is differentiating that a little bit. Self-employment tax is basically catching up for Social Security and Medicare for owners that haven't paid that. So I'm sure you're well aware of W-2s. You get half of your Social Security and Medicare withheld from that. So you see it coming out of your W-2 paycheck. And the other half is the responsibility of the company that pays the salary. The self-employment tax is saying, hey, you're not paying into that self-employment system that way to Social Security and Medicare. So instead you have to pay for it as a separate extra tax when you're a sole proprietorship or a partnership LLC. And so I caution people very early on when they're starting new businesses that they need to save a lot of the net taxable income for taxes early on. It's a whole different ballgame than when you're getting it withheld from your W-2. You not only have to pay ordinary taxes on your net taxable income, but you also have to pay, it's 15.3% is the total Social Security and Medicare tax that you pay in addition to your ordinary. So it's sticker shock when people are first starting with these partnerships, LLCs, because if you haven't thought that part through, oftentimes people won't save enough of their profits for tax. So that's a big differentiator with these top 3 here, sole proprietorships, partnerships, and LLCs, is that you're going to have to pay self-employment tax in addition to personal tax, the ordinary rates. Then when you move down to the C Corp, that's where we talked about that double tax, the corporate tax and the dividend tax. And then I'm going to skip the bottom 2 because that's probably a little too detailed for this discussion. But I do want to pause and talk a little further about S Corps, because if you'll notice, one major difference on this is in the tax column, we see self-employment tax, which I just kind of told you how much of a sticker shock that can have for self-employed business owners. You don't see self-employment tax there next to S Corps. And that is the major differentiator for S Corps versus partnership / LLC. In an S Corp, your taxable income at the end of the day it's only ordinary tax that you pay. It's ordinary income tax on the 1040. You don't pay self-employment tax in addition. So you're thinking, well, that's a no-brainer. Let's go that route, right? Well, of course, that'd be too simple. There's a complication there that I didn't get to yet. In an S Corp, you have to pay the owner, the business owners of the S Corp, a reasonable wage. And that term is extremely important, reasonable wage, and also squishy, undefined, and gray, right? So let's say an S Corp produces $100,000 in taxable income at the end of the day, revenue minus allowable expenses, there's $100,000. That's going to be taxed. However, what the IRS is going to come in and say, well, of that, you need to pay the owner, let's say it's one owner, you need to pay them a reasonable wage. So let's say that we decided $60,000 is a reasonable wage for this S Corp owner. They're going to have to give themselves a W-2, set up payroll and literally pay themselves a W-2 for that $60,000 reasonable compensation. And now that has changed their profit from $100,000 to $40,000. On that $40,000 of profit after taking out their own wages, that part does not have self-employment tax on it. It's just ordinary income tax. So that might be one of the tax saving tactics you might hear about on that, is that S Corps don't pay self-employment tax. That is true, except that you have to pay yourself a reasonable wage first. So if you'll notice in my example, we did not save self-employment tax on $100,000. We saved it on a portion of that. And you'll have to work with your team of experts on what is a reasonable wage. There is a lot of case law in there. The IRS absolutely looks at it if you show 0 for officer wages. There's a spot on the tax return. So you'll never want to file an S Corp with 0. But in my $100,000 example, what is a reasonable wage? It depends on your business. It depends on the industry that you're in. Are you getting all of your profit based on your know-how because of what you do? Or do you have employees, or do you have equipment or processes that you've created that allow you to have some profit? You'd need to have that second case to be able to say that not 100% of your taxable income needs to be your wage, that some of the profit from the business is not from your blood, sweat, and tears, so to speak. So that is the super high level grid example of all of those. And I think we talked a lot about this, but there's a few things I did not point out yet here. So I spent a lot of time talking about pass-through versus double taxation. So we'll just remember that from the grid before. And self-employment tax is what we were talking about just now. Flexibility in income splitting and deductions. This will come into play if there's more than one business owner. So if you have more than one person owning the business, there's a big difference between S Corp and LLC, which are the ones we typically compare to each other in those structures. If you want a lot of flexibility in who is being paid, maybe someone brought a building and someone brought know-how, and you want to decide how you're going to compensate those two different partners differently. A partnership allows you to have a lot more flexibility in how the profits of the company come out. Now, it's not a free-for-all. There's, of course, lots of rules, and they call it economic effect has to be into play that says at the end of the day, it's all going to basically wash out that whoever's getting the income from this is also paying the tax, is really what happens at the end of the day. But there is a lot of flexibility as to, hey, I want to pay the person that's putting their blood, sweat, and tears into this differently than the person that put in the building, let's say. A partnership allows you to do that, whereas in an S Corp, there are a lot more rigid rules on how the owners have to be compensated. And in fact, distributions to the owners in an S Corp have to 100% every time be equal to ownership. Whereas in a partnership, it does not. If you distribute differently, you have to true it up in the future, either with income being allocated to that person or with distributions being flipped the other way in the future. So that flexibility in how you distribute and how you split income is a major difference in partnerships and S Corps, and something you'd want to talk about with your attorney, with your CPA, to make sure that you're accomplishing your goals there. So I threw in a slide on sole proprietorship because, as I said before, that is the default. If you don't choose and physically apply with your state for something else, you are a sole proprietorship. And so I thought it was worth just pointing out that this will go on your 1040. It's called a Schedule C, where you do the math for your revenue and your expenses. And as I've mentioned a couple of times, this is subject to both income tax and self-employment tax on your tax return. So the pro is simplicity. You are this if you didn't say you were something else, and it's pretty easy to file compared to these other ones where you have to file entity returns. But the con is a very big con, and it is that lack of liability protection, which could be a big deal. And then I might go through this pretty quickly since we've talked about a lot of this, but it's just another way to look at it. On the S Corp, I can't stress enough that you are adding another layer of complication and another reason to pay your CPA here, because you have to be payroll compliant. So if you weren't going to have other employees as well, being an S Corp means that you now have to file W-2s and 941s and all those fun payroll things, because you have to pay yourself through wages, even if you have no other employees. And then the C Corp, pros and cons there definitely, but it does have its own tax that it will pay in addition to the dividends. So what type of entity is best? Well, of course, as in most things in the tax world, it depends. And I listed a whole bunch of things. We talked a lot about how the taxes are going to be different. Your income structuring and distribution structuring would be different, but there's other things like, how are you going to exit? You know, are you planning on selling the company, or are you planning on gifting your shares to your kids? There's a big difference in the different entity types there. What are your sources of capital? Do the owners have to put money in, or are you trying to raise outside funds? I will say if you're trying to have just capital investors where you want people to invest money into your company, people love to see C Corps for that, because then they don't have to wait and worry about a K1, which sometimes kicks off income without matching distributions, which is awkward for investors often. How will the business grow and develop? Do you want to put all the money back into the company, or are you going to be taking distributions all along the way? And then I added some others, which we won't go into, but there's, the asset sale, equity sale. These are all handled differently based on the different entity types. So ideally at the beginning of your idea for your business, you're going to sit with your CPA and your attorney and their crystal ball and say, hey, how are we going to operate this all along? How do we plan to exit? And throw all of that in the mix when you're deciding which entity type is best, because there are a lot of factors there. And I did say earlier that you can switch between them. There's sometimes that's a taxable event and sometimes it's not. That's what that last line is referring to, where usually if you're a corporation, it's hard to move to one of the other ones, but it is easier to move from a partnership or an LLC to a corporation if that's the path that you're trying to go. Okay, that was me trying to be quick in talking about the entity structure. So hopefully that gave you some idea of why I couldn't just dive into business income tax, because they are taxed so differently based on entity structure, but also hopefully gave you an idea of why that matters and why that's important. So then if we're jumping back to the basics of what we were trying to cover here and business income tax 101, then we have to talk about income and deductions for a while. So revenue is pretty easy. People usually know it when they see it, but it's basically all income that's earned from any business activity. So you might have different revenue streams. Whenever you're collecting money from customers, that's going to be your revenue, and it's the easier number to determine. If it came to you as taxable as money from a customer, it's probably revenue. Clients usually have a lot easier time telling me the revenue than what are their deductible expenses, because there's a lot of nuances to that one. But to get to your taxable income, thankfully, you're not taxed on all of your revenue, you're taxed on your taxable income, which you get to deduct all of your deductible expenses from that. Ideally, you have some sort of software that's tracking your income and your expenses. You are putting in the expenses based on categories, and I think we've touched on that in some of our previous webinars. But different categories are going to be treated differently. But the way to start is by saying, here's my bank, what happened? Money came in, money went out. Let's make sure we're showing all of those in different categories to get as much deduction as we can on those. But one interesting nuance to this is the timing of especially, I guess, revenue and expenses. When you start your business, year one of the very first things you do on a tax return is declare what type of method you're using for your taxable income. And there's two options, cash or accrual. I would say by default, especially small businesses tend to pick cash because it's easy to tell when things happen. You recognize your revenue when you receive the cash and your expenses when you pay out the cash. Credit cards, paying something on a credit card is considered cash. So if you put it on your credit card in December, it's deductible in that year, in that December year. Versus the other option that you can elect is to be on accrual, which is to say your revenue is taxable income in the year that you recognize that revenue. So once you bill the client and say, client, you owe us $10,000, that's taxable revenue right then, not when the client pays you. So the timing of that is going to matter a lot more at year end. But some taxpayers will look at how long their receivable cycle is. And if you have a very long receivable cycle, it might be more beneficial for you to be accrual, because you don't have to pick up that income until you it'd be the other way around. You don't pick up the income until you receive the cash. Versus, let's say you bill a client in December. If you're accrual, that's December income, as opposed to waiting until you receive the cash. Now, the flip side's true on your payables. So if you incur your expenses, your property tax or whatnot, before year end on accrual, that is deductible in the year it's incurred, not in the year it's paid. And so revenue and expense have to be treated the same, your cash or accrual for both of those categories. And it's based on what you pick your first year. The default is usually cash, which is usually easier for clients and taxpayers to track anyways. But just know that that is something you're hopefully working with your CPA in the first year. If you've already been filing, you've been making that decision, and you just need to stay consistent there. So then everyone's favorite topic, what is deductible? So as a business owner, you certainly want to take advantage of all the deductions that you are allowed. The overarching theory here is that anything that is an ordinary and necessary business expense is deductible. Of course, they paper that a little bit further in the law, complicate it a little bit further, but this is that's a very broad definition. That is in the IRS code, how they say it, ordinary and necessary. But people interpret that very, very broadly. It doesn't mean you have to choose the cheapest supplier or anything like that. If it's a reasonable, ordinary, necessary business expense, it's deductible. So I listed a few examples here. As I'm sure all business owners know, there's a whole lot of things that are deductible expenses when you're running a business. So you've got your advertising, supplies, rent, utilities, professional fees, all of that is in the mix and a lot more. When you're working on a tax return, whether it's a Schedule C from a sole proprietor or you're filing a separate entity return, you will see very similar categories on all of these that are these basic categories of advertising, repairs and maintenance, supplies, rent. Those are, you kind of have your different buckets for your deductions, and they're very similar on Schedule C, partnership, S Corp. And then there's the big other section where you're going to detail out, within reason, you're going to make your categories and detail out everything that doesn't have its own line up above on the tax return. So when you're keeping your books, you're going to want to keep them with some reasonable categories in mind to make filing your tax return easier. But in addition to these, which are kind of easy to track because you can follow your bank statement. You're seeing the money go out, and it's pretty easy to tell that that's a deductible expense item at that point. There are some other ones to consider, and that's what I've kind of started throwing in that second line. Mileage, home office depreciation, they don't always one-to-one equate to cash leaving the company, but these are deductible expenses. I'll touch on mileage for a second. There's two ways to get a benefit for car expenses. So as anyone that goes to gas up lately knows, it's more and more expensive to be putting those miles on your car. So one way that you can take business deductions for car expenses is called the actual method. Now, to do this, you'll have to track business versus personal miles as well. Let's assume you have a car that you use 100% for business. You drive your personal car to work, then you drive the company car around all day, and then drive your personal car home. Well, you could use the actual method very easily with that, because the car would be something that you could use. You could write off the value of the car through depreciation. You'd write off every time you go to the gas station for gas. Every time you go to the mechanic, you'd write that off. The car insurance would be 100% write off. That's the actual method for the outlaid expenses for the car. But most people don't do it that simple. Most people that are small business owners especially have a car that they use personally and for business. You can still use the actual method, but you'd have to keep ideally a mileage log showing how many miles you drove for business versus personal. And then each one of those expenses you would allocate to whatever the math came out. Let's say you did the math and 75% was business, 25% was personal. Now 75% of your gas and your car insurance and your repairs is a deductible business expense, and 25% isn't. For the most part, though, I would say the majority of taxpayers I see don't use that actual method, and instead they use the mileage method for deducting car expenses. It's a lot easier to track and calculate. So that's typically what people will do. And what it is the IRS says every single year they give you a mileage rate, and you just have to track your business miles. And for every mile that you drive for business, you get X amount of cents deducted for taxes. So I believe it's in 70 cents a mile, something like that. Now I always have to look it up, never commit it to memory. But if you said you rode 10,000 miles for business, you would take that multiplied by the IRS's allowable rate that year. I think it's 70 cents. So in that case, you'd have $7,000 business deduction for your mileage. And now if you use the mileage method, you do not also get to depreciate your car and write off your gas and your insurance. Instead, you don't show those on your income statement and you just take the mileage. So that's a juicy expense that helps the bottom line quite a bit, but is a little more complicated to calculate than just what hit your bank statement, right? Home office is similar, and oh, sorry, back to the other one. Nope, you were on the right one. So the home office is similar, where a lot of small business owners might have an office, but they also, maybe they don't have an office. Maybe it's all run out of their home, and the IRS will allow you to take a portion of your home expenses as a business expense. The caveat with home office is that you are supposed to use a certain space in your home. They say regularly and exclusively for business. So it shouldn't be also your dining room table in that case if you're using it for family meals and kid homework and all that. But if you have a dedicated office and you use it regularly and exclusively for business, then you file a whole different form to calculate it, but you get to take a portion of your mortgage insurance or your rent, your real estate taxes, your utilities, and even a depreciation on your home if you own your home as a home office deduction. And so that goes right off of the rest of your business income to lower it on your tax return. That's a more complicated calculation and discussion that you'd want to talk to your CPA about. But I will say, if you have an office space that's dedicated and available to you, it is much harder, if not impossible, to also take your home office as a deduction. And then I threw on depreciation, which is probably a whole nother week's course in and of itself. So I will just speak very briefly to this one. But basically, depreciation is the IRS's way of saying if you buy something that has a useful life of more than 1 year, you don't get to write it all off in year one, but you do get to write it off in chunks over a prescribed amount of time. So classic examples of this would be a building. If you have a building that you own for your business, you depreciate that over 39 years. So it's a tiny bit of it every year. But there are pieces in your building that can be depreciated faster. For example, if you bought new furniture, that would be over 7 years, or the IRS has a way that you can do accelerated depreciation to make it nice and complicated, and you could write it off all in 1 year. But you have to do it. You can't expense it as you would advertising and supplies. You have to go through this process of thinking through the depreciation schedule. You eventually get credit for this expense, this cash outlay, I should say, but it's not necessarily all in year one. And those are bigger assets. In fact, there's a friendly taxpayer law that says if the item costs under $2,500 and you make an election, it's a de minimis election, you can write it all off without worrying about depreciation. It's those costs that are more expensive, over $2,500, where you have to think through the useful life and work with your CPA on that. Then there's another section of deductions that may or may not be deductible. Meals is a very popular one. If you have meals where you're taking clients out for meals or you're offering a meal to your employee while they're traveling, that's only 50% deductible for the most part. Certain travel costs are fully deductible versus limited. Sometimes education can be deductible or not. So that's why that one says with caveats. So that's a little bit on what might be deductible. What is not deductible? And this is not an exhaustive list by any means, but these are more the ones that we see more often. So personal expenses is sometimes obvious and sometimes not. We really suggest that small business owners do not commingle personal expenses in with company expenses. Instead, we want them to be taking a distribution or some sort of compensation and then paying their personal expenses that way. Fines and penalties are another one. If you have a late filing penalty on your tax return, technically that penalty is not deductible when that's paid. That's a non-deductible item, cannot come off of your bottom line. Political contributions is another one. Charitable contributions you do get a benefit for, and it depends a little bit based on your entity type, but you never get a benefit for political contributions. Entertainment is a sad one because they changed that in maybe 2018, and those are 0% deductible going forward. If you're from Champaign-Urbana, the one I see the most is boxes for U of I games. Like those used to be 50% deductible back when entertainment was 50% deductible, but now entertainment is 0. I will say clients sometimes if they are doing an event and the event involves, let's say, a box seat at Memorial Stadium for football, they can show on the invoice separately if they have food involved. And so if you're catering the event and there's a food expense, that is 50% deductible, whereas the entertainment piece for the tickets to the football game is 0. And the other one that sometimes takes a minute to make it make sense in your head is owner's draws. So as an LLC owner, if you're paying the partners, let's say there's two partners and you're paying them owner's draws, this is how they're taking their profit out of the business. That's not a deductible item. That leaving that in there as not a deductible expense is how you are showing taxable income that you're paying tax on. Okay, one other thing I see small business owners wrestle with a lot that I wanted to just touch on today is employee versus independent contractors. So if you are a business owner, you're going to have to figure out which one of these buckets the people who work for you are in. The key difference is if they're an employee, you have, well, there's a lot of differences, but mainly they're W-2 now. You have to file payroll taxes for them, and there's other legal things you have to do for them as an employee. But from a tax standpoint, it's the fact that now the business is paying self-employment tax and Medicare on them, at least that half of it. The business is doing withholding, the business is withholding the other SE tax piece. So that's the employee side. If you're paying someone as an independent contractor, there is no withholding. There is no Social Security paid by the entity. Instead, that independent contractor is going to be self-employed when they file their income on their own. So employees are the W-2 payroll taxes. They'd have to have benefits depending on how many hours they're working. Whereas independent contractors, you still have a filing requirement, but that's instead of a W-2, it's a 1099 that you file at the end of the year to report how much you paid them. And there's no payroll tax or withholding on that. If you are an employer, if you're the business, it is probably pretty obviously way more simple to have them as an independent contractor as far as the filing side of it. There are a ton of rules, though, involved with whether they have to be an employee or an independent contractor. It's not something you get to choose. It's based on facts and circumstances. And so there are, I think I've seen a really good list of like 9 factors that shows which one they are. Sometimes it's extremely obvious. This person is coming 8 to 5 to your office every day. You're telling them what to do. You're giving them all the tools to do their job, and they're doing it the way you tell them that they have to. That's really obvious that it's an employee versus, okay, this person works once in a while when there's a project and you tell them what you need done, but they get to do it on their timeline with their tools, and they might even hire out other people to help them. That's the more obvious side of the independent contractor. What gets tricky is that there's a billion scenarios there that are in that middle range. So when is someone an employee versus an independent contractor is a really important decision, and not really a decision, but something you have to look at the factors and know which way it is. It's not like you're choosing, you are interpreting your facts to decide if they're an employee or an independent contractor. There are a lot of risks involved if you misclassify, especially if you're saying it's an independent contractor when they should have been an employee. So make sure to reach out to your professional partners on that, reach out to your CPA and your attorneys to get help if you are anywhere in that middle spot and not sure if they're an employee or an independent contractor. Let's see. We've probably, if you've come to the other webinars, you've probably already talked a lot about record keeping, but it is important to keep track of what you're doing all along throughout the year. Believe me, it is not fun to recreate 12 months worth of accounting activity. So find a system and a way to keep track of that as you go to keep your books clean. I will see clients, if they're business owners and they're handling their own books, so they're not always in touch with their CPA. I will see my favorite category, which says ask my CPA, that you can put in your QuickBooks or whatnot, where you can put the things where you're like, I just don't know if this is deductible or which category it goes into. Better to have that where some of them are there, but you've kept track of what you know than not. But you need to keep track of your income and expenses as you go. You need to have receipts. Your CPA does not have to see them always, but if the IRS came and had questions, that's what they would look to, is your receipts. I find clients have a lot more success when their receipts are digital, so you don't have to worry about them fading as time goes, as receipts do, but have some sort of system so you know where your backup data is. And then mileage logs. We talked a lot about the different ways that you would get your expenses for your auto expenses. And honestly, either way, whether you're using actual or mileage, you're still going to need to know how many business miles versus personal miles you had on those cars. So most small business owners would need some sort of software tool to help them keep track of all of this. QuickBooks is a very popular one, and we've listed a couple other ones there as well. I have just a couple more slides, and I am hoping to save time for questions. So start thinking of questions if you have them, or you can drop them in the chat if you haven't already. But I wanted to list a little bit on common filings, and then also make sure that people are aware certain types of entities have to make estimated tax payments. And I'll touch on that for just a moment. But your common forms we've talked about a lot already. Your 1040 is for your single member LLCs or your sole proprietors. 1120S is the S Corp tax return. 1120 is the C Corp, and a 1065 is the partnership tax return. But then you've got all these other filings, and this is not exhaustive by any means. You've got, if you need to file payroll, it's W-2s and 941s. If you had an independent contractor, it's 1099s. And honestly, even like paying your CPA, if you pay for services over $600, you need to be filing 1099s every January. So that's something to keep in mind and tag your professional partners to help you with if you need it. And then of course I was sort of concentrating on I was very much concentrating on the federal side. There's also all kinds of state and local things that you'd need to do. You'd have to file your state income taxes, which in our digital world often involves more than just one location. So your CPA, your tax professional, can help you determine how much does each state tax if you have customers in other states, employees, equipment. I would say employees and equipment in other states are slam dunk. You're definitely going to be taxed in both states. But do keep in mind, if you have a lot of customers in another state, simply having customers in a second state could create a state filing requirement in that other state. Thankfully, the states don't typically get to both tax you on it. It's for the most part one or the other, and you get a credit for some of the taxes you've paid in other states. In Illinois, for example, if you've paid Indiana taxes. But that gets pretty complicated, so tag your CPA on that. But more than just those income taxes in other states, you also might be required to register and collect and remit sales tax in other states, even if there's no physical presence, even if it's just clients in those states. So keep that in mind and make sure you're giving your CPAs and your partners there, your professional partners, enough information to help you understand where you have other tax implications for states or risks. But let me dive back up to the top of this slide then. With all of these, you need to think through when you're going to have to pay the tax. So W-2s are pretty easy. The tax is withheld throughout the year. Ideally, your tax is keeping up from withholding. And then in April on your 1040, you kind of settle up. If you owe or you have a refund, you go from there. All of these other entity types are more complicated than that when you're paying taxes, especially let's think of the flow-through ones that are coming to your 1040 and showing more income. Because you don't have withholding that's paying that tax along the way, you'll want to work with your CPA and your professional partners to figure out how much tax you have to pay quarterly. The IRS has a couple different ways that you don't have to pay underpayment penalties. It's either you cover 90% of this year's tax, which you usually don't know until 4 months after the year's ended, right? Or you cover 100 or 110%, depending on your income level, of the prior year tax. So when I'm working with taxpayers, if we think income's going to be the same or higher, we're always covering last year's tax for that safe harbor amount through quarterly payments. So they have to make an outlay, an estimate payment every April, June, September, and January to timely pay those and not have underpayment penalties and interest. It's similar on the C Corp with a little bit of different due dates. But that's something that if you're working with a CPA or a tax partner, they will help you understand, okay, when do we need to be paying in these amounts so that we're not paying an underpayment penalty or interest at the end of the year. But keep in mind that, you know, sometimes there's that sticker shock because you're paying in the ordinary tax on that, and potentially even the self-employment tax is all lumped together with those quarterly payments. And then similar to a W-2 person, let's say in the perfect scenario, your income skyrocketed. If you covered last year's tax through your estimates, you'll have a big tax payment due in April, but that April is still where you're going to settle up every year if you've paid in the quarterly estimates based on the prior year. That is the very quick explanation of that, but hopefully your CPA is walking you through when those tax payments are due and what you're paying when. So just a couple tips, pitfalls, and proactive planning items that you can use as a small business owner. Don't commingle your funds. If you have a personal item that you need to pay for, please take a distribution and then clearly pay for that personal item separately. Hire a good bookkeeper early on. Your books will be way more accurate if you're keeping up with them as you go than if you try and recreate them because, oops, it's tax time and I forgot to keep track of everything. So hire a good bookkeeper, have a good system early on, and work with your professional partners. And then I can't stress this enough, but talk to your CPA before major decisions. So hiring, especially if you're going to be hiring in a new state, or this is the first time you're having employees, talk to them before you get down the road of hiring, and they can help you set things up correctly on the front end. If you have entity changes, if you're going to take on a new partner or sell one of the partnership interests or anything like that, tag your CPA early because there's certain planning decisions we can maybe help you minimize the tax burden on that or defer that tax burden, but only if you're talking to us at the beginning. I will admit sometimes clients come to me and say, oh, this is what I did during the year. And I'm like, well, okay, like we will work with that. But next time, let's talk early because we could have set it up X, Y, and Z. Or before big purchases, if you're going to buy a new building, talk to your CPA first because there might be some incentives if they structure that differently, or if you're going to sell your building. It's always good to talk early and also get an idea of what the tax burden of these changes might be so there's no big surprises. So early and often is when I would say talk to your CPA. Similar, okay, I'm going to be a broken record there with the sooner the better. It is also good to just regularly update your CPA on what's going on. There's certain things that you're going to think are just business decisions, but they're going to have tax impacts. So it's also good. We can help you with planning if you're talking about, okay, this is where my pain points are in my business. Here's where my goals are in the future. We might be able to give you some proactive planning on all of that. So new locations, new lines of businesses, taking on employees. There's a big list there, but I would say your CPAs like to hear about your business because it helps us think of more ideas. And we love being strategic partners with the business owners. So, you know, sometimes it feels like you're just doing the chit chat, but your CPA's gears are turning when you're talking about your business. So make sure you update them on what's going on that horizon. I think that got me through my slide deck. So we've got about 8 minutes still scheduled, and I would love to answer questions. It's hard for me to know which areas are going to be the most interesting or spark questions. So if anyone has questions, please let us know.
Thank you so much, Mandy. We don't have any questions right now. We did have someone say hi in the chat. So uh, if you have any questions, feel free to put those in the chat and we'll get them covered. We have a few minutes here still, so we can hang tight to see if anything comes in. But I do know we also had some people jump on after we had already started. So I do want to remind everyone that you will get the follow-up to this. So if there's something you want to go back and revisit that Mandy discussed, see that chart again or anything like that, you will have access to do that. So we'll get that email out. That will go out first thing tomorrow morning. So.
Thank
All right,
you.
we got a question. It says, what software do you recommend to keep track as a sole proprietor?
QuickBooks is my favorite. Like we found that QuickBooks, either the desktop or QuickBooks Online, is actually relatively user-friendly. Obviously, the software is trying to do a lot for you at once, so there is a bit of a learning curve, but the vast majority of our clients use QuickBooks and have had good success with that. If you're working with a CPA, QuickBooks Online is excellent because you can also give your CPA access to that. So rather than having to pull your financials and give the CPA just what they need for your tax return, the CPA can go right there, grab what they need, dig into accounts if they have questions, and it saves a lot of the back and forth. So that's my favorite. We also have people use Quicken. I would say with caution, if you only have a very few items of revenue and expenses, sometimes I'll just see an Excel sheet from people telling me what category that is, but that gets out of hand pretty quickly if you've got a lot going on in your business.
All right. Oh, go ahead. Sorry. No,
I was going to dive into the next question.
Yeah,
so
go for it.
What should someone be looking for when hiring a CPA? I would say it depends on what you need from a CPA. Some CPAs are going to be experts in certain fields. So if you've got a lot of multi-state action going on, make sure your CPA is familiar with interstate rules, things like that, or has a SALT team, state and local tax that works with them. But otherwise, you probably want to talk to them about what your needs are. Some CPAs are way more proactive on planning. And really probably my first question to a CPA would be like, what is your ideal client? Like who do you enjoy working with the most? Because they're going to dive in and work more when it's their passion. For example, I really enjoy working with small businesses and then work with them on their business and personal, because I feel like there's a huge opportunity for planning there. And I really enjoy being that like strategic business partner where I'm helping the client with their pain points and helping them with tax planning, things like that. Whereas some people might just want, I just need compliance, like don't do anything fancy. I need the 1065 and the 1040 done every year. That's fair too. So I would say ask them to be upfront about their pricing as well, because there's going to be a difference there based on the level of service. Let's see. Does the firm offer tax strategy? Yes. Ways on lowering taxable income. And then, yeah, I would say our firm in particular, MH, we love partnering with our clients, and every client wants to save taxes in the right way, right? So we want to be compliant, but we don't want to pay more than the client's fair share in tax. So that's always a part of our discussion. We will, at worst, once a year when we're delivering the compliance work, at least give you our thoughts on what we're seeing. But ideally, we like to have those deeper conversations where we're saying, what's going on in your company? What are your pain points? What's your future look like? And we love to dive in and be that strategic partner. The times where we can do the most bang for our buck on the tax strategy are when you're doing changes. So if you're thinking of selling a building, maybe there's an opportunity for a like-kind exchange so that you can defer some of that gain. There's also some big opportunities before you start your entity. Talking about entity structure, we love helping people with that, or helping with exit strategies. Really, anytime there's a big transition, a big transaction, we would love to dive in with people. One of my specialties is the state and local tax area. So I found there's ways to actually save people by doing SALT planning on strategically and intentionally using the different state work that you do to your advantage. So it's definitely something that our firm is passionate about, is helping with strategy, being that strategic partner, and of course, not trying to pay more than your fair share on the income tax side. Sometimes that's planning. I did not dive deeply into depreciation, but if you had a big purchase that is a depreciable item, talking through when to time that deduction for the opportunities you have is helpful. Interestingly, sometimes it's worth deferring the deduction if you're in a lower tax bracket now. I also didn't talk at all about retirement planning, but that's another big way that we can help people understand, timing of those retirement contributions to save tax or do the Roth. There's a whole bunch involved there as well. So yes, that's something we really enjoy doing. You also, though, for strategic partners, my favorite is when you have a good team. So you've got your CPA that can work in their area. You got to have a good attorney for certain areas. And then I'll often also work with a financial planner, and we can do really great things when you've got your CPA and your financial planner putting their heads together at the same time. So I would say work hard on building your professional team, and you'd want those three legs to that stool: CPA, attorney, and a financial planner. That would take you far into your goals. Great questions. Thanks for asking those.
Thank you so much, Mandy, for answering those. It doesn't look like we have any more rolling in, so we will go ahead and wrap up today's session. Thank you everyone so much for joining us and taking time out of your day to be here. And thank you so much, Mandy, for presenting to our attendees. Again, that follow-up email will go out tomorrow morning, so be on the lookout for that. But again, thank you everyone for being here, and we will go ahead and close out. Have a great day.
Okay, thank you.